So, welcome to the Forex Crypto Hub beginner lessons, lesson 4, where we are going to be talking about market orders. Market orders. We have different types of market orders. So, that's what we will be looking at today. We look at the market orders and also we place them so that you can go and give them a try also on your side. So, the other day I defined to you what an order is. I defined to you what an order is. I hope you still remember. So we can just start here. I hope you can see my screen. The reason I mostly share my screen is because maybe we have some of you who are not writing and they might miss something I've said, but from the screen they can see it and write. So I hope you can see my screen. I hope you guys can see my screen, right? Sorry, I've not shared it. Let me share. Okay, now it's clear. Now everything is clear. So we start there where we have market orders. So what is a market order? You can see the definition there is market orders are instructions you give to your broker on how or when to execute or exit a trade. So you just, is it a buy? Is it a sell? Is this going to be a point where you're going to exit the market, or is this a point where you're going to be entering the market? So that is what an order is. Just like, let's say you just go to an hotel, you're going to give out and you're going to order something. So just relate it that way. You just relate it that way. So that is what market orders are. And we have different types of market orders. So we have types of market orders. We have instant executions, instant executions. We have pending orders. We have stop loss order. We have take profit order, right? So we are going to start with the first one. We're going to start with the first one, which is instant execution. We are going to start with the first one, which is an instant execution. So what is instant execution? Sorry, instant execution is an order placed at the current market price. So let's say right now we spot an entry in the market. You just go and place it as a buy or a sell. That is what we call an instant order. That is what we call an instant order. How? Let me do it. Let me check on the chart then. I join with my phone so that now we will be doing these things practically. Man, this thing was so sweet. The ones who joined that Sunday session, market just came to that point exactly at the point we were looking at this one, because we were expecting the market to reverse between the two, either the lower line or this, and then the market reversed at the upper line. So for those who have caught that entry, got good pips. And so okay, now we will be using the demo account. Remember the other day we created a demo account, right? So we will be using that demo account for practice. That is what we will be using to practice these orders, on how to execute them. On how to execute the market orders, we are going to be using those demo accounts. So now oh, let me join with my phone so that I can be doing it on this side. Okay, so now I've joined with my phone. So let me finish up with this. Then we can now practice that. So we have said an instant execution is an order that is placed at the current market price, right? When you want to enter the market right now, so that is now what we call the market order. Like right now, let's look on the gold price. Gold is at 43.11. So you just go to your MetaTrader 5 and execute a buy or a sell. So that is now what we call an instant execution, right? The second type of an order is what we have here is a pending order. Pending order, as the name suggests, is waiting. So pending orders are orders placed in advance on the belief that prices will react at specific levels in future. And we have two types of pending orders, that is limit orders and stop orders. Then under limit orders, remember we are either buying or selling. So under limit orders, we are going to have two as well. So limit orders, these are orders used when you expect the market to pull back before continuing, or when you expect the market to change direction. So simply this means a limit order is placed against the market direction. So if the market is selling, the order you are going to place is a buy limit. If the market is buying, the order you are going to place is a sell limit. You are placing it against the market direction because you have that kind of a belief that the market will change the direction or is going to reverse. That's why now we are calling them what? That's why we are calling them uh, uh, pending orders. You just place them early in advance. So like right now, let's say you can see gold is coming up. Let's say you expect the market to come to a point like let's say 43.30, and then it will start selling. So you will come here and place now a sell. You will come and place a sell limit at that point. We'll just go to that point and place a sell limit. So let's say half of this at this point at 43.50, that's where you expect the market to go up to, and then it will continue selling. So you will now come at this point 43.50, and you place what, the kind of an order here, we call it what, a sell limit. Remember, currently the market is buying, so we expect it to continue buying up to where we have our point of interest. That is now the 43.50, and then now at 43.50 we can do what? We can take the sell there. I don't know whether you have understood that. So that is now what we are calling what? That is a sell limit order. Are we together on that, or you are not connecting the dots? So this is the kind of order we call it a sell limit. A sell limit is placed above the market at a point where you believe the market will come to and then reverse or change from buying to selling. Then the opposite of it is now what we are calling the buy limit. So let me use a pair with the USD because the pairs with the USD have been buying, so right now they are selling. You can see USD JPY, it has made a good move. So let's say we expect this pair. Let's say we expect this pair to come down to here, half of this. We expect it to come. Currently the market is buying, so we expect it to sell up to this level and then go up. So the order we are going to have here now is what we are calling a buy limit. So we just place the order early enough, and then wait for the market to come to our point. Hello, are you getting it? Are we together on that? So um having shown you those two, they have explained everything here. And these are buy limit order, an order placed to buy at a specific price or better, placed below the current market price, right? You have seen that as I was demonstrating there. Used when you expect the price to drop to a level and then reverse upward. So you expect the market will come to a certain level and then go up. That is now when you use the buy limit or order. Placed when the market is selling. So the market is selling, so there's a point you're waiting for it to sell up to, or what we call a support level. So you expect the market to come to a support. Then we have the second one, which I've demonstrated as well. That is a sell limiter, an order placed to sell at a specific price or better, placed above the current market price, used when you expect price to rise to a level and then reverse down. So you market is buying, you expect it to reach to a certain point and then it will sell. I hope we are together up to that point. Now let's check on the last the stop orders, so that now when we go to demonstration on the in our demo accounts, we will do all of them at once. Now we have stop orders. Stop orders are used when you expect the market to continue moving in the same direction after breaking a level. So if the market is selling and you expect it to continue selling, you place a sell stop. If the market is buying and you expect it to continue buying, you place a buy stop. So what is the explanation here? Stop orders are used buy stop. An order placed to buy once the price moves above a specific level, placed above the current market, used when you expect price to continue rising. Okay, placed when the market is buying. So stop orders are in alignment with the market direction. So if the market is buying, the order you can place there is a buy stop. If the market is selling, the order you can place is a sell stop. Like in this example, current market is here and you see the market will continue buying. So you come here and place now a buy stop at a price above the market. Okay, let me come back. Okay, right now on our chart, right now on our chart, let me clear this. Now the current price is at this point, right? And we expect market, maybe we expect now the market to come back to where it had gone high, right? So what I'll do, I'll come to a point above the current market, probably at a point like this, and I will now place what? A buy stop, because I expect now the market to come and surpass this point with a lot of force. So I'll place my buy stop here early before the market reaches there. If you place when the market has already reached there, it's not going to accept it. So I'll place early so that when the market comes, it will activate my order. And after activating my order, if it goes my direction, I'll be on profits. But now if it activates my order and it goes against what I had placed, if I place a buy and the market sells, I'll be in losses. I hope you have got it. Huh? You have understood that. Now, for let me go back to gold and explain now for the sell stop, sell stop, sell stop. So, like currently, the market is here. Currently here is where we have the market. The market is at this 43.18. Market is at 43.18. And we see that the market will continue selling to 42.70. So what I'll do, I'll come to a point below 43.18. I'll come to maybe 43.16, 43.17, a point below that, and then I'll place the order. We are calling it what? A sell stop order, because I believe the market will continue going down, right? So I hope you have understood that. So now I can shift I can now shift and start sharing my screen so that okay, start sharing my screen on the phone so that now we can uh, we can now execute the orders with you, so that now we can start executing the orders together. So so this is the demo account. This is the one we are going to be using. We will be using the demo account. So now we will start with what the orders we have. We will start with instant executions. So let's say I want to trade gold. I click on XAUUSD, then I click on new order, and then what do I want to place? Is it a buy or a sell? Currently the market on gold is very bearish. So what I'll do, I'll just click on sell, and my order will be executed. You can see currently my order is now running below there. It's on a negative. It's at negative $2.13. You can see it keeps changing because we have had news and the market is still very volatile, right? So when you go to XAUUSD, then you click on chart, you will now see your order where you have placed it. Here is the order where we have that red dotted line. Where we have the red dotted line, that is now where we have our order. I hope you can see that. So that is now what we call an instant execution. You place at the right, just instantly at the market price. Hmm? Let's say it's this one, Nasdaq. I just click on buy. That is an instant execution. I've placed with the current market price. I hope um, that one is clear, right? So now uh, that was instant execution. Let's come now to the other types of orders where we had buy limit and sell limit. So let's start with what? Let's start with the buy limit. Buy limit. So let's check on the charts first. Let's say you can see currently gold is selling. Let's say we see gold will drop to that 43.05 and then it will buy. So I'll come to my chart. You can see already the price is super fast. So I'll go to a point below. So I'll go to new order, and then you can see up there we have market execution. You click on market execution, you're going to see those orders. So we are going to place what? A buy limit. And if it's a buy limit, it has to be a price below the current market. So it can be 42.98. You can see currently the market is at 42.98. It's already surpassed. So 42.95, and then I place. So when you come to the chart, you can see my order is here. It's not activated, but once the market touches there, it will now get activated, and the line will now be showing. This is where my order is. I don't know if maybe there are some who don't see it. This is now where we have this kind of a gray line. That is where my buy limit order is. Can you see it now? Buy limit order. There it is. Right? So once the market taps at that point, my order will be activated. So when you come to trades, you can see the order is not active. It's just showing you placed. But the moment the market touches there, it will now start showing either profits or losses like the other ones. I hope you are together on that. So you can see now the market has tapped that point and it's reversing up. You can see that's why you can see it's having a profit of $2. Market has tapped, and then so that means our order is now active. You can see our order is active here, right? So I can come and close the order. I can just come and close the order. I hope you have known how to place a buy stop. Sorry, buy limit. I hope you have known how to place a buy limit, right? Hey man, gold is very, yeah. Just I don't know, even less than 5 minutes, the market has moved 220 pips. Yeah. Anyway, it's okay. So now let's place what? Let's place a sell limit. So I'll use Japanese GPU, USD GPU since the market is going up. So I'll place an order above the current market. So I'll place at 160.47. So I go to USD JPY, new order, market execution. So this time what order am I executing as a sell limit? So current market, you can see current market just here on your left, just below the lot size. 0.01 is a lot size. So 0.01 is the minimum. You can just edit and enter the lot size you want, but for beginners it's highly advisable you use 0.01, 0.01. So I come to price, I clear everything and then I edit 160.48. So you can see it shows me place. If the market has come to that point, I will not have that option for place. So like right now, you can see my option is no longer there because the market is at 160.48. So I can now go to a point to a different one. And in this case, let me go to 160.5. Then place. Once I've placed it, let's come on the chart. Chart, USD, JPY. Click on chart. You can see our order is right here, just slightly above the current market. So when the market pushes up to that level, our order is going to activate. So if you are using a pending order, let's say your account balance is $20. You have used a pending order. Your balance will remain 20 until the market activates that order. Activating the order is when now the order will start reading like this ones, either profits or losses. That is now what we call order activation. So now, like currently, when the market goes up and it touches our sell limit, the order will be active. And let's say maybe the market does not go to that point, it now starts selling. That order will still remain there until maybe we shift it or we delete it. Shifting is like, okay, removing it from that point of 160.5 to maybe 161 or another point. I hope you can get me on that. So the order remains there. Now, I've already demonstrated to you how to place what? A buy limit and a sell limit. Can you be in a position to do it? Yes. Are you in a position to do this? Okay, that one, yes, Salia Kosawa. Just type in the message section. Mary is okay, can be able to do that. The rest, you can also react. Auntie is okay. Her reaction is it's okay. Ruth is okay. Let's save time. Just react. If you can be able to do that, just react. Okay, silence means you can all do that. I'll be uploading the video to our YouTube channel. You can as well visit it for reference if maybe you will be having challenges, or you can DM. I'll help you on that. Okay, now we are done with limit orders. We are done with limit orders. Now let's get into stop orders. Stop orders. Stop orders. Stop orders. Stop orders. Right? Stop what? Stop orders. So you can see gold is selling. So the order we can place here is a sell stop. Current market is at 42.90. So we have to place the order below the current price. We can place it at something like 42.80. 89. So let's do so. XAUUSD, new order, market execution, then sell, sell stop. You come to the price and then you edit 42.89. Market is already past that point. So 42.8. Hey, market is moving very fast. Okay, 42.80 before it reaches to that point. You can see already the market has activated our order. It's very volatile. We can place another one. Maybe for some of you have not seen the order being made. Market has just tapped it very instant. Okay, the other order we had on USDJPY, you can see it has already activated. And you can see here, when you are in a trade and is in profits, it will show you blue. When it's a loss, it will show you red. If you are in neutral, that is 0.00 profits. No profit, no loss, it will be gray. Also, if you have a pending order, it will be gray. So let's do this. For gold, let's place another sell limit order below this at 42.70. 42.70 what? New order, sell stop 42.76. Okay, now you can see our order. Here is our order. Let me go to 1 minute so that you can see it. You can see here is our order, sell stop. So once the market drops and it touches our point, the order is going to activate. When you come here, you can see our order is here, sell stop. Already market has hit the point and our order has activated. So once market activates your order and moves to your side, you will be making profits. But if it activates and it goes against you, you are going to be in losses. The first entry we entered here, man. Maybe someone might have entered it on their accounts right now. They could have 370 pips, 370 pips, 37, $38, $39. Yeah, Hippo Siku, let's keep learning. Your time is coming. So, we are done with the we are done with the sell stop. Now let's check on buy stop. And buy stop, I'll use USDJPY since it's on a buy. Actually, I should close this. The one I used to demonstrate for you, the sell. Remember to close a trade, you just come to the trade where the one you want to close, then you swipe left, and then we have that. We have the first icon, the second icon. So you click on the first icon, then it's going to show you close with profits or loss. So I close with loss, and our order is closed. Right? So since the market is buying, a buy stop is an order we are going to place above the current market. Current market is at 160.553. So I'll place an order at 160.554. So new order, market execution, then buy stop 160.54. Market is already there, it cannot execute. 150.55. So you can see it has given me now the option to place. So I click on place, and the order is there waiting for the market now to come. So once the market goes up, once the market comes to this, the order will activate. Market goes above it, we in profit. Market activates and drops, we gonna be on losses. Are we together? Hey man, this gold is crazy, and tomorrow gold will still be crazy. Gold will be crazy. It has to fill this gap. It has to fill this gap, which was left on Monday. We have this gap. It has to be filled. This gap has to be filled. So market will come to this level probably, but not exactly at that level. The high probability will be, when is tomorrow? Tomorrow is on Thursday. So we have Thursday and Friday. This was the low of last week, so it's going to be it won't be easy to take out the low of last week. Okay. I'm explaining to you some things which are for later. But for those who trade and are in this meeting, tomorrow you can look for sell entries as well. The market will keep on selling, but it will have to go back a little bit. It will depend on how it opens on Asian session. It might open drop to that level and then give a little bit of a buy and then now sell further, but we'll see how it goes. So guys, that is it. That is it, guys. I don't know if we have anyone with a question. Anybody with a question? That is it. What is the time? Maybe let me see if we can do something else. So there are two orders I've not talked about. That is a take profit order and a stop loss order. I have not talked about those two orders for a reason. First, you need to first understand the ones I've done, because you can't take a profit or you can't set a stop loss when you have not entered the market, right? So you need to first do what? You need to first enter trades. Okay. So yes, yes, yeah, please. When you are buying, okay. If you are in a buy trade, where is your stop loss, above or below? Just a simple question. Below, right? So that is the same thing, That's the same thing you are going to do, because if you are if you are in a buy if you are in a buy if you are in a buy if you are entering a buy stop, that means you are taking a buy trade, right? If you are placing a buy if you are placing a buy stop, that means you are going to place what? A buy trade. And if you are placing a buy trade, your stop loss has to be below. And then if now you are placing a sell stop, it's like you are taking a sell trade. So your stop loss should be above the entry point. I hope we are together on that, right? So okay, so let's see what next year. We are done with the market orders. Uh-huh. So for this one, those who will be watching on YouTube, watch practical examples on how to place market orders on YouTube channel. That is the Forex Crypto Hub. Okay, but for you, we have done it live with you, so you are good with that. So now we go to these key terms, and I believe by the end of this we will have covered uh, everything on basics, and then now in our next class we can start doing technical analysis where the real job starts. Okay, so
So another thing, John Liniambia tu
So key terms, this explains the key terms every trader must understand. So the first one we are going to check here is spreads. Spreads. Spreads is the first one we will be checking. What are spreads? What are spreads? So spreads is the difference between the bid or the buy price and the ask or the sell price. So that is what we call spread. When is one is a spread, but you will know when they are many, they are now spreads, spreads, spreads. Okay, so it is the cost you pay to enter a trade. Lower spreads means cheaper trading cost. Like the broker we are using, that is just markets. For those who maybe have not yet created their accounts, just go to the group description and you will see the link to create your account there. Just click on the link and you'll be able to create your account there. So now the broker we are using gives lower spreads compared to others. I've been working with just markets for quite a long time. So that is now what our spread is. So when you are entering a trade, you have seen that when you place your trade is going to start with a negative because of what? Because of spreads. Now the next thing is pips. What is a pip? Yes, let me see what's up. Let me see. Oh, okay. Now back here. So what is a pip? Or when there are many, there are pips. So first, a pip stands for percentage in point. The first P is percentage, I is in, then the second P is in stands for point, percentage in point. A pip is the smallest price movement in a currency pair. So if the market moves from 120 to 120.3, that 0.3 difference, that is now what we call a pip, right? That is what we call a pip. It measures the amount of change in an exchange rate. It measures the amount of change in an exchange rate. So that is, I hope now you are getting now what a pip is. For most currency pairs, a pip is the fourth decimal place. That is for currency pairs, most of them. But for Japanese yen pairs, a pip is the second decimal point, and for gold is the first decimal point. So when I talk of these decimal points, I'm talking about them because when you are going to be calculating pips, you will be using those decimal points. So let's say it's for currencies. For currencies, you will get that a currency has five decimals. Have 5 decimals. So the ones you are going to focus on is they are the first 4. You will focus on the first 4. You ignore the last one. But I'll show you when we are dealing with now how to calculate the pips. I'll just do a video on calculating pips because I don't know if Nini, what do you call it? I don't know if the one we are using here has those tools for doing some writings and so on. So I'll check. If I'll not get it, I'll just record video doing it and then I'll share with you. Now the other one is leverage. What is leverage? Leverage is the ability to trade positions higher than your account balance. So trading on leverage is like borrowing from a broker. So you will get that different brokers have different leverages, and many people will prefer to use different types of leverages. There are those who like or prefer to use higher leverages, others will prefer to use lower leverages for some reasons. So on leverage, it's a topic which it's normally deep, so you can go and do more research on leverage so that you can understand it better on your own. How? So most people prefer brokers which offer higher leverages, because now if you have a small capital like $10 and you are using a leverage of let's say like in just market the maximum leverage is 1 is to 3,000, so you get that you will be able to place a trade on gold like even 4 or 5 trades. But in some brokers where the leverage is 1 is to 400, you are not even able to place one trade on the same. So leverage is important. When it's in your side, it's good. When it's against you, inakuramba. So the other one is swap. What is swap? Swap is the interest charged or earned when you trade is held overnight. So let's say like right now you entered that gold sale. Let's say you entered the gold sales and you decided you are going to hold that trade for maybe a day or 2 days. So when you leave that trade running, the broker is going to charge you some fees, and that is what we call a swap fee. It's not that much, it depends with the lot size you are using, the broker as well. They might charge you $1 or even less than $1. So I hope you have understood what swap fee is, right? Yeah. And then we have what we call a margin. Margin. What is margin? Margin is the amount of money required to open a trade. Margin is the amount of money required to open a trade. You only pay a percentage of the full trade value. Let's say you have $10. Executing a trade doesn't mean you are going to use all the $10. Let's say like okay, let's say we are trading on gold, and you get that the broker the margin for the broker is $1.5. That means if you have $1.5 and not 10, you can also place the same what? You can place the same trade. And if you have $10, you are going to be using what? $1.5 so that your trade can execute or is going to accept, right? Yeah. Uh, Margin allows traders to control larger positions with smaller capital. That's true, because you get that we have like currencies. We have currencies with lower margins like USD JPY, Audi USD, GBP USD. All these pairs you can trade them with less than $1. But trading lower capital, it requires skill. It requires an entry skill. You need to be getting snipers, patience as well, because growing a small account is not easy. All these things you will come across them later maybe. For now, yeah. Okay, yes. Let's see now what a free margin is. Free margin is the money available to open new trades. Free margin is the amount of money available to open new trades. So if you are in a trade and the trade is in profit, your free margin is higher. If you are in a trade and they are in losses, the free margin is lower. So we have that formula there. Free margin is equals to equity minus used margin. So when you go to your MetaTraders and click on trade, remember we have placed some trades when I was demonstrating on how to execute them. So you click on trade and now start checking from where we have balance, equity, free margin, margin. You are going to see all these things there. Okay, let's go to the next one is equity. What is equity? Equity. Equity is the real-time value of your trading account. right? So like um we have account balance. Account balance is the money in your account before you place any trade. But now, after you have placed your trades, the balance that is at that account is now what we call equity. So let's say your account is $200 and you entered that sell on gold, which went for let's say 30 dollars. So the equity is going to read $230, because if you close that trade at that price, the new balance becomes 230. I hope you have understood it now. We have a formula there. Equity is equals to account balance plus open profit, that is run interest profit, and if it's in a loss is now account balance minus, you subtract. Then we have a margin call. A margin call is a warning from broker when your margin level falls too low. So we have some brokers like we have a broker used to use sometimes back. Alikuwa anaitwa FX Pesa. That broker, when your margin is below, is it 95 or 70, they will start calling you, oh, deposit, do what, no. So those kind of brokers, I hate them. No, why are you calling me? I know my margin is low, so but why do you call? So okay, when you come across such kind of brokers, and you are a beginner, you normally face a very huge challenge, because every time they will call you and you will think they are now the experts, what they are doing I should follow. If your account is $50, they tell you to add something like $100, and maybe the trend is against you. You end up losing $150 where you could have lost maybe the $50. So I those brokers, man. Mm. Okay, let's go to the next term. That is a lot size. A lot size is the unit used to measure trade sizes in forex. So this is just like quantity. Do we call it quantity? Like you can go and buy 1 kg of flour, 2 kgs, 3 kgs. Yeah, that is now what a lot size is like here in forex. So you can see I had we have lot type, uh, lot size unit, then the pip value. Mhm. So we have a standard lot. That is a lot from one all the way to, even if your broker accepts at 10,000 lots, we call it a standard lot. Standard lot. Then we have a mini lot. Mini lot is from 0.1 to 0.999. 0.99. 0.1 to 0.99. That is a mini lot. Then we have a micro lot. That is 0.1, sorry, 0.01 to 0.09. 0.01 is the least or the lowest lot size that is used in forex, and that is what you beginners are highly advised to start with. And each lot value has its value. Sorry, each lot size has its value. So just for simple calculations, it's the lot size times 10. So if it's a lot size of 1 times 10, so the lot value is $10. If it's 0.1 lots, is times 10, so the lot value is $1. Then if it's a 0.01, the lot value is $0.1. So that means if you enter let's say you have used 0.01 and the market goes on your side 10 times, that is 10 pips, so you will have gained 0.1, that is the lot value times 10, so you will have gained $1 as your profit. If it goes 100 times, you will have gained $10. Like the one I shared, sorry, the one we were doing some demonstration with, which went up to $43. The lot size was 0.01, so that means the market has gone to 430 pips. So if you could have used a lot size of 1 on that, it could be 430 times 10. That is $4,300. So the bigger the lot size, the bigger the profits, the bigger the losses as well. Okay, so we have some few examples here about the pips and so on. Pip value 0.01 is equals to 0.1 per pip. If you are using lot sizes of 0.02, it's going to be that. So the number of lots, okay, let's say you are using a 0.01 and you have opened 5 positions. No, 3. So it's going to be 0.01 times 3. So the total lot size you are going to be using in that will be a 0.03. Remember, one position is, one lot is equivalent to 0.1 $0.1. So it's a 0.1 times 0.03. So you're going to get the total lot value. In that case, it will be 0.3 dollars. Then now times the number of pips you're going to gain in that trade. So yeah. So risk and reward ratio. Risk, this is how much you can lose in a trade. Risk is equals to stop loss minus entry. Profit and loss calculation. So profit is profit or loss is equals to the pip value times the number of pips. So how do you get the pip value? You get to know the lot size you have used. You first get to know the total lot size, then you times it now with the lot value so that you can know the total lot value. So yeah. So the other one here is about how to calculate pips. I've said I'll see on what to do on that. How to calculate pips. I'll do something on that. So now next week we are entering technical analysis. We are entering chart work. That is now what we call technical analysis, guys. So make sure you avail yourself, because this is the most important thing we will be doing now. Yeah, so that marks the end of our today's session. If you have any question, just unmute your mic and ask. So I'll be uploading those videos. I know I have lesson 3, I have part 2 I've not yet uploaded, then lesson 4, and today lesson 4 or 5. I'll confirm on that. They'll just be following each other in order. So once you go to our YouTube channel, and you guys no, actually, I thought I was sharing my screen and you guys have not told me. Anyway, once I upload it on YouTube, you're going to see it. Okay, damn it. Just look at it. Eh? Oh, yeah. Still, it's okay. What? 1550 pips. What? It's okay. So I was saying something. What was I saying? Okay, I was saying when you go to our YouTube channel and then so when you come to our YouTube channel, the Forex Crypto Hub, this is our YouTube channel. So if you have not yet subscribed, you just go and subscribe, guys. So you come to playlists. When you come to playlist, you will see we have different you can see we have pro farm trading, we have weekly market forecast, we have forex trading lessons, the traders daily word, we have shorts, we have fundamental analysis. So you will come now to where we have forex trading lessons. So and when you come to forex trading lessons, you will see that we are the playlist. Here is the playlist. Already the ones which are here are two: lesson 1, lesson 2. Lesson 3 is on the YouTube channel, but I've not yet brought it to this category. So I'll be doing so shortly. I'll be doing so you'll get it there. Yeah, so that's how simple you can be checking on those lessons. And yeah, so guys, we can call it a day. We can call it a day. See you